Welcome to the investment update. I'm here with Ayrton Oliver, one of our investment portfolio managers who specialises in bonds, and I'm Stephanie, one of the advisors here.
Thanks, Stephanie.
Thanks, welcome. So last year was a volatile year for interest rates and bond markets. Does 2024 have more of the same in store?
Yeah, so last year we had quite a lot of volatility. It was all driven by the aggressive hikes we had in 2022. So as central banks tried to increase monetary policy, hike rates to tame inflation. And then last year, interest rate markets tried to gauge whether or not they'd done enough to get inflation under control. At the same time, trying to balance this against the economy slowing and whether or not the consumer was going to get too hit by this increase in interest rates. You could say now that interest rate markets have made up their mind. They think that it's done enough, inflation is falling, and that interest rates will be cut later this year. And so we now are expecting interest rates to be heading down from here. Although it's not to say the volatility might not be over. There is a lot of new economic data coming in, and as expectations change, this could cause changes on when interest rates might be cut and if they can be cut soon.
Okay, so what kind of data are investors watching?
So inflation is definitely the main one. Central banks need to get inflation back into their target ranges. But other than that, there is other things that are quite important, such as employment. So employment's a key one, as it can lead inflation, and especially things like services, which is a factor that central banks are very keen on trying to get down at the moment. So if you think about employment, the way it leads it is if there's more demand than supply for workers, there's going to be more wage pressure. People can get paid higher because they're more in demand. And this flows through into businesses having to pay more for their workers. It means higher prices for them, higher prices for other people, and that leads inflation. It also means that employees get paid higher wages, they've got more income to spend on goods and services. With supply otherwise constrained, that means that they can spend more money and buy more things, which is inflationary.
Right. And we are hearing more and more that households are feeling the financial pressures. So how does this factor in?
Yeah, so the sentiment or the way economies are feeling is also measured. We try and gauge this through surveys. So there's business and consumer confidence surveys. These try to gauge the idea of what consumers are feeling, how they're thinking, and what their intentions might be. So if these consumer surveys are suggesting that consumers are not going to be out there spending money, businesses might stop hiring, they might stop making investments, and this could slow the economy down quite a bit.
Right, and what has economic data been like to start the year?
So far for the year it's been very strong. So if we start with the US has been extremely resilient. The economy is in a very, very good place. It appears very healthy. Their inflation rate, although not falling fast enough, is still back down to 3.4%, which is a lot closer to target. It's a lot lower than that 9% we had in 2022. And on their employment side, it's also very strong. The employment surveys and employment data that came out last week was much stronger than expected. And so this is leading to the central bank, their Federal Reserve, starting to feel kind of confident that inflation is going the right way. It's heading the right direction, but they're not really ready to say that they've declared victory yet, which means they're not going to cut rates yet. But it also means that they think that they've got it heading the right direction, so probably cut rates later this year. In New Zealand, it's somewhat the same, very, very strong. The inflation rate came down from 5.6 to 4.7% last week for the fourth quarter. So it's heading in the right direction. The RBNZ's happy with that. Although if you look in the details, inflation was mainly driven down by tradables inflation, which is goods like food and fuel, which is not really in control by the RBNZ. So inside the details, the non-tradables inflation, which is services and domestic driven stuff, the stuff that the RBNZ's trying to get down with their own tightening cycle, didn't come down as much as expected, which will be a bit of a concern. So that's definitely weighing on the market. And on the employment side, it's also very, very strong in New Zealand. So that's a concern for the RBNZ. Although unemployment did increase from 3.9 to 4%, it didn't increase by as much as expected. And this will be weighing on the RBNZ's thinking of how fast inflation come down. So back to what I said earlier with wages, wages went up more than expected, which means that it could be harder to get inflation back down as people are getting paid more.
And what does this all mean for interest rates?
So interest rate markets have probably got a little bit ahead of themselves earlier this year, so starting to think that there's going to be multiple cuts from central banks across the globe. And this drives down wholesale 2 and 3 year interest rates, which is good news for bonds and good news for mortgages. However, there's been a bit of pushback from central banks saying, look, it's not over yet, we haven't got inflation down. And also that stronger than expected data and a strong expected employment data globally has meant that the markets had to start to rethink whether or not inflation has actually come down enough for central banks to start cutting just yet. So this means that for the start of the year so far, New Zealand interest rates have gone up by 0.35% or 35 basis points. And we do have some central bank meetings coming up. So we've got the RBNZ coming up at the end of this month. They're expected to hold rates unchanged, however, probably increase the rhetoric or just go back on the same rhetoric and reiterate that interest rates are not going anywhere down soon, and that they're likely to be on hold for a long time until we start seeing more confirmation from the data that inflation truly is back down into range. However, with the stronger data and the hawkish stance they've got, there has been some talk in the markets now saying you can't rule out another hike, which would be quite shocking for all of us with the mortgages, but that's just the way it is with our central bank, and they've been pretty keen to tell us that we really need to see inflation back in that 2 to 3% range.
So is this good news, bad news for mortgages, rates, bonds and global markets?
So in general, having the end of the monetary policy tightening and central banks starting to cut rates is going to be favourable and good news. Bonds and equities will both like that, and mortgage rates also, if we start seeing lower rates pass through from lower interest rates into lower mortgage rates. However, given that central banks have said they're probably not going to cut as much as the market expects, and the market is kind of pricing in more cuts than central banks have said they've alluded to, it means that it could be some time before we see those interest rates coming down. They might not be cut as soon as possible, or as soon as people may have hoped. This is probably not going to cause too many issues, but it just means it might be later this year instead of earlier this year. It might be later this year instead of earlier this year that we start seeing mortgage rates coming down. For bonds, it's good news. It means that you can buy bonds at higher rates before the rates start going back down. So for New Zealand investors right now, you've got the ability to invest into corporate bonds between 5 to 7%, for instance. There's a bunch of new corporates a bunch of New Zealand corporates that have bonds maturing the next 2 months, so like the likes of Vector, Spark and Meridian Energy, all companies that New Zealand investors would know who have bonds that are maturing in 2 months' time, which will need to refinance them. So they'll be coming back to the market to issue new bonds at these new higher rates that are much higher than they were when they issued them previously. So these are good for bond investors. They get to lock in a higher rate and an attractive yield. But on the flip side to that, these companies have to come and borrow money at a much higher rate than they probably locked in earlier. That will lead to higher costs and interest costs for those companies. Yeah. And for equities, they may not see the interest rate relief that they're expecting at the moment, thinking there's going to be more cuts than the central banks have alluded to. But in general, the economy is still pretty resilient. And so I think going forward, if we do start to see these interest rate cuts, it should be pretty beneficial for equities. One thing I would point out, though, is all of this is premised on a resilient economy and economic conditions staying the way they are, with a strong consumer and a strong, healthy employment market. If we do start seeing some massive cracks in the economic outlook, it could be from geopolitical, it could be financial, banking, or even just the consumer slowing down much more than expected, then I think all bets are off the table and we might see more cuts deeper and further than expected.
Wow, thank you for the insight. Thank you for watching.